All right, Bruce, when it makes sense to buy down a mortgage and when it doesn't, because historically, Renee and I have always been huge fans of taking the highest interest rate. People think we were crazy, right? We would take the highest interest rate, but when rates were low, we would take the highest interest rate as often as possible because that lowered our cash out of pocket, right? And now I hear a lot of people, they're like, well, I want to buy down my rate. I want to buy down my rate. Can you talk about when that makes sense and when it doesn't?
Absolutely. So in a higher rate environment, I typically recommend to my clients to take the approach that you mentioned, take a higher rate relative to the market, and maybe use credits to offset the cost of the interest rate. The idea and the goal there would be long-term, we're going to track the rates with the market and make sure that you're always in the best loan possible.
Right.
So if you have less upfront costs that you incur to begin the loan process, that's a smaller break-even period to recoup those costs. So it's easier for you to make the right decision to redo your loan when rates drop in the future. Typically, the buy down options, there's one of two reasons that you'd use a buy down option. And that's where basically you can pay a premium to get a rate below what the market rates are today. One of those two reasons would be qualifying. For some reason, we needed to get your ratios in line to make it to where you could qualify for the loan. That would be one of the suggestions where maybe we look at buying down the rate and using some points to get you a lower rate than the market. The other time that maybe it makes sense to use a buy down is when we get to the absolute, or what we think will be the absolute low for historic rates. Because the likelihood of you redoing your loan, if rates drop to lows that we saw during the COVID period, you could get, with buy downs, you could buy your rate down into the 1%, high ones, low twos. A 30-year fixed below 3%, probably unlikely that you'd see that again.
Right.
So if you can buy it down to the mid twos, that's a good value. The longer you keep your home relative to the cost you paid for that rate, it's called a break-even period. So as long as you stay in your loan beyond that time period, you're going to recoup those costs, and every month after that, that's a value or a savings guaranteed. When you don't know how long you'll stay in a loan, or there's a likelihood that rates drop and you would redo your loan, it's more likely than you're not going to get to your break-even period, and those funds are now wasted.
So if I hear you correctly, I need to understand how much is this either going to save me by taking a higher interest rate or cost me to buy down that rate, run the break-even analysis, and then judge, do I think I'm going to be in this same mortgage in X number of years later to justify either the purchase or the buy down, or the increase in getting a credit, or the buy down and spending more. Is that a fair way to think of that?
Absolutely. If you look at that break-even period and you have a good partner that helps you gauge your goals and objectives relative to the market, they can help you make a good decision on when the time's right to buy down your interest rate, maybe pay a premium to go below the market, or maybe take the other direction where we go a little bit of a premium above the market, offset those costs to make them as minimal as possible, and again, make the recoup period close to nothing.
Yeah, Renee and I have a real life example of this. When Renee and I bought our investment property in Royal Oak, we took the highest interest rate available on the market, and that was 2014. And we ran a break-even, when I say we, she did it. We ran a break-even analysis of 8 years it was going to take before it started to cost us $15 more a month, right? $15 more a month. So 8 years from now, and if we were still in that same mortgage, it was going to cost us an extra $15 a month. And we thought to ourselves, one, I don't know if I'm going to own this house in 8 years, right? First and foremost. Second, I have no idea if I'm going to be in this mortgage 8 years from now. And sure enough, we've refinanced that property twice at this point, right? And it is 10 years later, roughly, and 11 years later, and we've refinanced it twice. We do still happen to own it, but we've refinanced twice in that period of time. We've refinanced well in advance of that 8 years. So we made out way better by taking the highest interest rate than we would have done if we would have taken the par rate, which is market rate, or bought it down, right? If you would have bought that rate down, you absolutely were going to refinance the COVID, right, at the COVID rate. So that's the type of analysis that an expert like Bruce can do for you. And based on your goals, you'll be able to determine what's the right approach for you. So if you have any other questions or concerns about what you should be doing with your mortgage, go ahead and reach out. We'd love to chat with you about it. And if you like more content like this, go ahead and subscribe. You can pay to see all of our videos. Thank you.